Welcome to the deep dive. Today we're getting into Balkrishna Industries Ltd. You probably know them as BKT. They're a really big deal globally in off-highway tires.
Absolutely, a major player.
And to really get under the hood, we've got their latest investor presentation, their Q1 results for fiscal 26, and some notes from their recent board meeting.
Yeah, plenty of material to dig into.
So our mission, for you listening, is to pull out the key insights from all this, help you get really informed on where BKT stands now, performance-wise, and where they're heading. Find those aha moments.
Let's do it.
All right, let's kick off with the numbers. They always tell a story, don't they? We're looking at Q1 of fiscal year 2026, so that ended June 30th, 2025. What were the main figures? Sales volume, revenue, EBITDA, net profit.
Okay, so looking at the standalone numbers for Q1, it's a bit of a mixed bag, especially when you get to the bottom line. Sales volume was 80,664 metric tons. That's actually down slightly, about 3% compared to last year.
Okay, down 3% on volume.
Right. But interestingly, revenue actually nudged up by 1%, hitting Rs 2,759 crore.
So less volume, but slightly more revenue. Pricing, perhaps, or mix.
Could be mix, yeah. But then EBITDA, which is their core operating profit, that fell 8% year over year to Rs 655 crore.
Right.
And that means the EBITDA margin, how much profit they make from operations per rupee of sales, that dropped. It's down 228 basis points, landing at 23.8%. So that's like a 2.28 percentage point dip in operating profitability.
Okay, so margin squeezed a bit there.
Exactly. But the real headline, like you hinted, was net profit. That took a big hit. It's down 40% compared to last year's Q1, coming in at Rs 287 crore.
Wow, 40%. That's substantial.
It is. Though on a maybe brighter note for shareholders, the board did declare a first interim dividend. It's Rs 4 per share for FY26.
Okay, dividend's always something. But yeah, that 40% drop in net profit, especially when revenue was slightly up.
Yeah.
What happened there? What were the main factors driving that?
Well, it's interesting because several things kind of came together. It wasn't just one thing hitting the P&L. First off, the gross profit margin felt some pressure. This was mainly because a smaller share of their sales came from exports this quarter. India sales volume was around 35% of the total.
And India sales have different dynamics, maybe lower margins sometimes.
Potentially, or just a different product mix effect. So that higher domestic share, plus the impact of tariffs on sales going into the USA, that directly impacted the EBITDA margin too.
Oh, tariffs. Right.
Yeah. And, pretty simply, lower overall sales volume meant they just weren't absorbing their fixed costs quite as well. Less production spread over the same factory costs, basically.
Makes sense. Lower utilization.
Exactly. But the really big hit, the one that explains most of that 40% drop in net profit after tax, or PATE, it came from something outside their day-to-day operations. It was a mark-to-market loss, M2M loss, of Rs 154 crore.
Mark-to-market. So like paper losses on financial positions.
Precisely. It's about revaluing assets or liabilities based on current market prices. In this case, it looks like a sharp jump in foreign exchange rates was the main culprit. It turned what was actually an M2M gain in the same period last year into a pretty big loss this quarter.
Ouch. So currency swings really bit them.
They really did. And on top of that, higher depreciation charges also played a part in reducing the net profit. It just shows how external factors, like Forex, can really move the needle, even if core sales are kind of stable.
That's a really good point about the M2M impact. Okay, so we've got the Q1 picture. How does this fit into their sort of longer-term sales volume trend? They've been growing volume generally over the last few years. And what about the Q1 breakdown? You mentioned India sales were up, but what about byproduct or channel?
Yeah, good question. Let's zoom out a bit. Historically, BKT's volumes, FY23 was 301,181 metric tons. Then FY24 saw a little dip to 292,628. But they bounced back quite well in FY25, hitting 315,273.
Okay, so FY25 was a record year then.
Looks like it. So that 80,664 MT for Q1 FY26, while down year on year for the quarter, fits into that broader picture of recovery and growth from FY24. Now, for the Q1 breakdown you asked about. Segment-wise, agriculture tires are still the biggest piece of the pie, making up almost 59%.
That classic BKT segment.
Definitely. Followed by OTR, off-the-road tires, for mining, construction, industrial stuff. That's about 37%. And then a small others category at nearly 4%.
How are they selling these? Mostly direct to manufacturers or replacements?
Overwhelmingly replacement. That market was 73.3% of their sales in Q1. So end users buying new tires. OEM sales directly to the equipment makers was about 25%.
Interesting. So the aftermarket is really key for them.
Hugely important. And geographically, Europe is still their biggest market, around 38.4% in Q1. But India, as we mentioned, was significant at almost 35%. Then the Americas at 17%, and the rest of the world making up the remaining nearly 10%.
So still very much a global player, but with a strong and maybe growing domestic Indian base.
That seems to be the picture, yeah.
Okay, so that covers sales. Now, beyond the P&L, which had those headwinds this quarter, what about the balance sheet and cash flow? How's their underlying financial health looking? Because that tells you about their ability to weather storms and invest, right?
Absolutely crucial question. And here the picture looks, well, quite a bit stronger. Total assets have grown steadily. They stood at Rs 15,560 crore as of March 2025, up quite a bit from Rs 13,605 crore the year before.
Okay. Asset base growing.
And total equity, the owner's stake, also grew nicely to Rs 10,384 crore in March 2025. Importantly, their debt-to-equity ratio for the Q1 FY26 standalone results was just 0.32 times.
0.32. And that's pretty low, right? Conservative?
Very much so. It's consistent with past periods and suggests they're not overly leveraged. They're managing their debt prudently.
Good to see. What about cash flow, operations versus investing?
Right. Net cash from operating activities was Rs 1,753 crore in the full year FY25. That was actually down a bit from FY24. But, and this is key, net cash used in investing activities remains substantial. It was a negative Rs 1,477 crore in FY25.
Negative meaning they spent that much on investments.
Exactly. That's not a bad sign at all. It reflects that they're continuing to invest heavily in their future growth, building capacity, which we can talk more about.
Right, funding that expansion.
Precisely. And maybe the most important buffer. They reported strong gross cash and cash equivalents, basically, readily available cash of nearly Rs 3,500 crore as of June 30th, 2025.
Okay, so almost 3,500 core in cash. That's a solid cushion.
It's a very healthy position, yeah. Gives them a lot of flexibility.
Okay, this is where it gets really interesting for me. Because despite that tough Q1 profit number we talked about, their investor presentation keeps highlighting a resilient business model. How does that square up? What actually makes their model resilient, beyond just saying it is?
Right.
And then what about these big growth targets for 2030?
Yeah, it's a fair point. How can you talk resilience after a 40% profit drop? But the resilience they're talking about is more structural, I think. A huge part of it is their self-reliance in carbon black. That's a critical raw material for tires, and making it themselves gives them control over supply and cost. It's a big deal.
Like vertical integration, basically.
Exactly. Plus, they have multiple sources for other raw materials, so they're not overly dependent on any single supplier. And their total tire capacity is set to reach about 425,000 metric tons per year, or MTPA, once all the current expansion work and debottlenecking efforts are done.
So scale and supply chain control.
Right, and also diversification. Their product portfolio is incredibly broad. Agriculture, industrial, construction, earth-moving, mining, port, even lawn and garden and ATV tires. So if one sector slows down, others can potentially pick up the slack. It spreads the risk.
Okay, that makes sense structurally. Now what about the future? This 2030 vision sounds ambitious.
It really is. They're aiming for a 2.2 times revenue growth by 2030. That means getting to around Rs 23,000 crore from the roughly Rs 10,600 crore they did in 2025.
Wow, more than doubling revenue in 5 years.
Yeah, it implies a compound annual growth rate, CR, of something like 17% per year. That's pretty aggressive growth.
Where's that growth supposed to come from?
They've broken it down. About 70% is expected from their core off-highway tire segments. Then, interestingly, about 10% from selling carbon black to third parties leveraging that capacity.
Ah, so selling their surplus production. Smart.
Seems like it. And the remaining 20%. That's slated to come from launching new tire categories specifically for the Indian market.
New categories. Like what?
We'll get into the details, but some passenger cars and commercial vehicles.
Okay, big move. And how are they funding all this?
They've earmarked significant new capital expenditure, or CapEx, about Rs 3,500 crore over the next 3 years. That's specifically for expanding carbon black, developing rubber tracks, and launching these new tire categories. The overarching goal: to hit an 8% global market share in the OHT segment.
8% global share.
Wow.
Big target. Okay, let's unpack that strategy a bit more then. How are they planning to execute across these pillars, OHT, carbon black, and these new Indian market ventures?
All right, let's break it down. For OHT, the core business aiming for that 70% of revenue growth and 8% global share. In agriculture tires, it's mostly about sustaining their leadership, consolidating their position. But the really exciting part, I think, is mining tires.
You mentioned that earlier.
Yeah, BKT is apparently the only Indian company that's developed all-steel radial technology for tires up to 57 inches. These are the giant tires you see on huge mining trucks.
Okay, that's a serious capability.
It really is. And they offer a full range in both the older bias technology and these newer radial ones. That gives them a clear path to grow much faster in the global mining tire market, which is high value.
And the other OHT areas.
Well, they already have a strong footing in tracks, industrial, and construction tires, and they're specifically expanding a dedicated factory for rubber tracks, think tracks, for tractors or construction equipment, with production planned for the second half of 2026.
So strengthening existing areas and pushing hard into mining.
Exactly. And all this is supported by that capacity expansion. We mentioned the ongoing 35,000 MTPA plus debottlenecking gets them to that 425,000 MTPA total OHT capacity. That's what underpins the 8% market share goal. They even mentioned 10% as a longer-term strategic target, achievable through future modular investments.
Okay, that's the OHT plan. What about carbon black, targeting 10% of revenue?
So the board approved a major expansion here. They're going from 200,000 MTPA up to 360,000 MTPA.
Big jump.
Huge. The idea is to capitalize on synergies, like using the energy generated in the carbon black process to power the tire plants and better integrate raw materials. They're even adding another 24-megawatt cogeneration power plant, bringing their total self-generated power at the Bhuj site to 64 milliW.
So more self-sufficiency and capacity to sell externally.
That's the plan. The expansion should be done by early 2026, making them a bigger, reliable, high-quality supplier to other tire companies worldwide, not just feeding their own needs.
All right. And pillar 3. These new tire verticals for India, aiming for 20% of revenue. What's the specifics there?
This is a really interesting move. They're planning what they call a modular entry into premium passenger car radial tires, PCR, and commercial vehicle radial tires, or CV radials.
So cars and trucks. A very different market from OHT.
Very different and huge, especially in India. Their initial focus is purely on the Indian replacement market for both, not OEM initially.
Starting with the aftermarket again. Makes sense.
Yeah, maybe lower barriers to entry. The plan is to launch a pilot for CV radial tires in Q4 of FY26, so early next calendar year, and then ramp up slowly. The PCR tire pilot is scheduled to follow a bit later in Q3 of FY27, again with a gradual ramp up.
So a phased, careful entry into these massive new segments.
Seems like a sensible approach, yeah. Testing the waters.
Okay, those are some ambitious plans across the board. Given all this, what are BKT's core competitive advantages? What really gives them the edge to pull this off? And alongside that, how are they handling sustainability and ESG that's increasingly important for investors and customers?
Good question. What's their moat? A big one we touched on is that carbon black plant generating power. That drastically cuts a major manufacturing cost energy and gives them control over a key input, shielding them from some market volatility.
Right, that vertical integration again.
Definitely. They also point out they have enough land, the necessary upstream equipment is in place or planned, and crucially, they believe they have the people and systems needed to manage the scaling up.
The operational capacity?
Yes. And don't underestimate brand building. They have invested quite a bit in it, especially in India, with ambassadors like Ranveer Singh and Ravi Tandon Ashwin. They expect that brand investment to pay off even more now across a bigger revenue base and new product lines.
Leveraging the brand recognition.
Exactly. And importantly, they project that even after all these big investments come online, their blended profit margins should stay healthy, somewhere in the 23–25% range. And they don't expect a major drop in return on capital employed, ROCE.
So they believe they can grow significantly and stay highly profitable.
That's the expectation they're setting, yes, which is key for investors.
And the ESG side, sustainability.
They seem quite proactive here. On energy efficiency, they mention installing windmills, 5 MW, and solar, 7 MW, for greenfield projects, using their 40 milliW captive power plant, and recycling waste gases from the carbon black process to cut coal use. That's quite clever.
Using waste for energy. Nice.
Yeah. Environmentally, they talk about controlling emissions with electrostatic precipitators, proper wastewater treatment, and they've planted, get this, about 100,000 trees around their Bhuj plant.
Wow, that's a lot of trees.
It is. They also focus on waste management, scrap collection, safe disposal, reuse, recycling things like reclaimed rubber, and this seems to be getting recognized. Their S&P Global ESG score is 53, which they say puts them top among Indian peers. Their CRISIL ESG rating is 57, termed adequate, and their credit rating was recently upgraded by CRISIL to AA plus stable.
So tangible efforts and improving ratings.
Name so. They also mentioned community work, education, health, rural development for underprivileged groups. So
Mhm.
trying to cover the environmental, social, and governance aspects.
Okay, quite comprehensive. So let's try and pull this all together. What does this whole picture mean for you, our listener, trying to understand this part of the industrial world?
Well, I think BKT gives us a really interesting case study. You see a company facing some undeniable short-term headwinds. That profit drop was real, driven partly by external factors like Forex.
All right, the Q1 numbers weren't pretty on the bottom line.
No. But at the same time, you see them making these very significant strategic long-term investments. They're doubling down on their core strengths like OHT and carbon black integration, while also boldly diversifying into huge new domestic markets.
So it's about looking past one quarter's results to the underlying strategy and investments.
Exactly. We've seen how one tough quarter, especially with that non-operational M2M loss, could maybe make you miss the bigger picture, the resilience built into their model through diversification and vertical integration, and these massive CapEx plans aimed squarely at gaining market share and driving future growth.
Yeah, this deep dive really shows BKT isn't just, reacting. They seem to be actively trying to shape their future with these big bets on new products, expanded capacity, while also, importantly, weaving sustainability into how they operate and compete.
It's a proactive stance for sure.
So, as you think about all this, here's something to chew on. In today's really fast-changing global economy, could BKT's approach this dual strategy of cementing leadership in their core global niche, OHT, while simultaneously making a big push into new, high-volume domestic segments like passenger car and truck tires? Could that be a kind of blueprint for other established industrial companies looking for sustained growth and long-term relevance?
That's a great question to ponder. How do you balance defending your core with finding completely new avenues for growth? BKT seems to be trying to do both at once. It'll be fascinating to watch how it plays out.